Welcome to today's video. We're diving deep into some core principles of stock investing that every smart investor should know. This is not just about picking stocks based on hype or market trends, but a deeper understanding of what makes a company truly valuable and worth your hard-earned money. So, let's get started. 1. Evaluating a company's competitive advantage. The economic moat. The very first question you need to ask yourself when investing in any stock is, what kind of competitive advantage does this company have? This is crucial because companies with strong competitive advantages tend to thrive over the long haul, delivering consistent value to shareholders. The concept we often use to describe this edge is known as the economic moat, a term that vividly captures how well a company can fend off its competition. Now, let's dig into what an economic moat really means. Imagine a medieval castle surrounded by a moat. The wider the moat, the harder it is for invaders to attack. In business, a company's moat works the same way. The wider and stronger the moat, the harder it is for competitors to steal market share or disrupt the company's success. There are generally three types of economic moats that a company can have. 1. Wide moat. Companies with a wide moat are the powerhouses of their industry. These businesses are built to last, with competitive advantages that we believe can endure for over 20 years. Their advantages are incredibly difficult for competitors to erode. For instance, think about companies like Google or Microsoft. Google's vast data ecosystem and its powerful search engine, combined with its dominance in advertising, make it nearly impossible for competitors to dethrone. Microsoft, with its Windows operating system and Office suite, holds a commanding position in enterprise software. These companies have entrenched themselves so deeply that they're expected to remain on top for decades. 2. Narrow moat. Companies with a narrow moat have some competitive advantages, but they are not as well protected as wide moat companies. These businesses are still strong and can fend off competitors for around 10 years, but their advantages are more vulnerable to disruption. Take, for example, a company like Netflix. While it was once the undisputed leader in streaming, competition from other platforms like Disney+, Amazon Prime, and HBO Max has gradually eaten away at its dominance. However, Netflix still holds a significant lead thanks to its strong brand and massive content library. 3. No moat. These are companies without any meaningful competitive advantage. These businesses face intense competition, and their market position can quickly be eroded. In such cases, even if they perform well in the short term, the long-term outlook is uncertain. For instance, many smaller retail chains fall into this category. They operate in highly competitive environments with little to no brand differentiation, making it easy for customers to switch to alternatives. As an investor, you want to focus your attention on wide moat companies because these businesses are best positioned to generate high returns on capital and create lasting value for shareholders. Wide moat companies are more likely to maintain their market share, continue growing profits, and protect themselves from competitive threats. How to identify an economic moat? So, how do you identify whether a company has an economic moat? Well, moats usually stem from 5 key sources. 1. Cost advantages. Companies that can produce goods or services at a lower cost than their competitors enjoy a significant edge. Think about large retail chains like Walmart. Due to its sheer scale and logistical efficiency, Walmart can offer lower prices than most of its competitors, which helps it maintain dominance in the retail space. 2. Switching costs. When it's costly or inconvenient for customers to switch from one company to another, that's a competitive advantage. For example, banks often have high switching costs because it can be time-consuming and complicated to move accounts, direct deposits, and other financial services to a different provider. 3. Network effect. This occurs when a product or service becomes more valuable as more people use it. Social media platforms like Facebook or LinkedIn are great examples. The more users these platforms have, the more valuable they become to new users, which in turn makes it harder for new competitors to gain traction. 4. Intangible assets. Patents, trademarks, and strong brands can protect a company from competition. For instance, pharmaceutical companies often hold patents on drugs, allowing them to enjoy monopoly-like profits for a set period. Meanwhile, luxury brands like Louis Vuitton or Rolex benefit from brand recognition and customer loyalty. 5. Efficient scale. This occurs in industries where only a few firms can operate profitably due to high barriers to entry. Utility companies are a good example, as setting up the infrastructure for electricity or water distribution requires significant upfront investment, making it hard for new entrants to compete. 2. Determining the value of a company's shares, the fair value estimate. Now that you've identified a company with a strong competitive advantage, the next step is figuring out whether its stock is worth buying. This is where the concept of fair value comes into play. The fair value estimate is essentially what you believe a company's stock is worth based on its future ability to generate cash. It's the price you think the stock should trade at, given the company's future cash flow potential. By determining fair value, you can make better decisions on whether to buy, hold, or sell a stock. For example, let's say you analyze a company and determine that its fair value is $103 per share. This means you believe the stock is worth $103 based on its long-term growth prospects. If the stock is currently trading at $90, it's undervalued, and you might want to consider buying. On the other hand, if it's trading at $115, it's overvalued, and you may want to hold off on purchasing it. But how do you determine fair value? Here are a few important factors to consider. Revenue growth. How fast is the company growing its sales? Companies with strong revenue growth, especially those expanding into new markets or launching innovative products, may have higher fair values. Profit margins. It's not just about how much a company sells, but how much profit it makes from those sales. Companies with higher profit margins are typically more valuable. Cash flow. Ultimately, a company's value is based on how much cash it can generate. This cash can be used to pay dividends, reinvest in the business, or pay off debt. Companies with strong and predictable cash flows often have higher fair values. Industry trends. The broader industry trends play a crucial role. Is the industry growing, shrinking, or facing significant regulatory hurdles? Companies in growth industries, like technology or renewable energy, might have higher fair values compared to those in more stagnant industries. It's important to note that price doesn't always reflect value. Just because a stock is trading at a high price doesn't mean it's not worth buying. The key is understanding the difference between the stock's current price and its intrinsic value. 3. Measuring a company's margin of safety, minimizing risk. Even when you've found a company with a strong competitive advantage and determined its fair value, there's one more critical concept to understand before making an investment decision: the margin of safety. The margin of safety is essentially the cushion you want to have between the stock's fair value and its current price. It accounts for the uncertainties in the market, the company's future performance, and any unforeseen risks. For example, if you believe that a company's fair value is $103 per share, you might set a margin of safety of 10%. This means you'd be comfortable buying the stock at $93 or lower. The larger the margin of safety, the more protected you are against the risk of overestimating the company's value or underestimating potential risks. The size of the margin of safety depends on several factors: business stability. Stable, well-established companies with predictable earnings and lower risks may require a smaller margin of safety. In contrast, companies operating in volatile industries or with uncertain future prospects may require a much larger margin of safety. Economic environment. In times of economic uncertainty or market volatility, it might be wise to require a larger margin of safety to account for unexpected events, such as recessions or market corrections. Personal risk tolerance. Some investors are more risk-averse than others. If you're someone who prefers to minimize risk, you may want to incorporate a larger margin of safety in your investment decisions. Putting it all together, a comprehensive approach to stock investing. To sum it all up, successful stock investing is about much more than just following trends or market hype. It requires a thoughtful and strategic approach to identifying companies with lasting competitive advantages, determining their intrinsic value, and ensuring that you have a sufficient margin of safety. Here's a recap of the key steps. 1. Evaluate the company's competitive advantage. Look for wide moat companies that are built to last and capable of maintaining their market position for years to come. 2. Determine the fair value of the company's shares. Calculate what you believe the stock is worth based on its future cash flow potential and growth prospects. 3. Measure the margin of safety. Ensure that the stock's current price is low enough to provide a buffer against potential risks or market volatility. By following these principles, you can make more informed and rational decisions in your stock market investments. Whether you're a seasoned investor or just getting started, these concepts are crucial for building a successful portfolio. Conclusion: investing wisely requires a combination of deep research, disciplined analysis, and thoughtful risk management. Understanding competitive advantages, fair value, and margin of safety will give you the tools to make smarter decisions and achieve better results in the long term. If you found today's video helpful, don't forget to like, subscribe, and hit the notification bell so you won't miss future content. Leave a comment below to share your thoughts or ask any questions. I'm always here to help you on your investing journey. Thank you for watching, and I'll see you in the next video.